Hey there, Coin Nations. My name is Kellogg Fairbank, and I'm the CEO of Nash. I'm coming to you from Amsterdam, the Netherlands. I'm here today to talk to you about crypto-based earnings and ask, will it change the future of finance? Decentralized finance, or DeFi for short, has grown from approximately 500 million in May 2019 to more than 150 billion as of today. And that's in total value locked, which is TVL. I'll explain why we think this is going to be a multi-trillion-dollar industry in only just a couple of years. The agenda for today is we'll discuss our current financial system, how interest rates work, and the DeFi revolution and what it means for the consumer. Today's financial system doesn't work for everybody. When interest rates lag behind price inflation, saving money means losing purchasing or buying power. Let's look into how interest works to understand why this is happening. As you can see, interest rates in Europe are extremely low or negative. Here are the interest rates on savings accounts with some of the most popular banks in Europe. They are pretty low, and it's sad to see. If you want a higher return, you'd have to lock your money for 12 months or longer, or are restricted to a maximum deposit amount. Many banks also have negative interest rate on balances over 100,000 euros, charging you to leave your money with them. And most importantly, these rates are also far behind price inflation, and this is a big problem. We've all seen the headlines. Stories about negative interest rates have all been over the news during the past couple of years. Low interest on loans means low interest on savings accounts. Why is interest on loans so low? It's pretty simple. Governments don't want people saving money. Central banks force these low rates. So let's try and understand why that is. The answer is a well-known theory in economics, the paradox of thrift. The thinking behind this paradox informs a great deal of modern monetary policy. The more people save, the less money is circulating in the economy, which slows it down. This is bad when the economy isn't doing well. The more people save, the less money is circulating in the economy, which, you guessed it, slows it down. In times of economic downturn, governments slash interest rates to encourage spending. It encourages cheap borrowing and discourages saving. The goal is to stimulate the economy by keeping as much money circulating as possible. Look at what happened to interest rates after the 2008 financial crash. After that financial crash, interest rates fell rapidly and have not recovered. If today's financial system doesn't work for everybody, what are the alternatives? The alternative is a new, decentralized system of digital money based on blockchain technology. All previous systems for making money digital relied on trusted parties. This is because moving money or moving things around digitally actually duplicates them. So if I send you a photo from my phone, you end up with a copy of the photo on your phone, in addition to the original that exists on my phone. There's no way this could work with money, since coins would be duplicated and spent twice. This is why trusted third parties were always involved until Bitcoin solved the double spending problem. What can DeFi do, and what are its main advantages? It lets us recreate the entire financial system on the blockchain, but without middlemen. So you can do anything done in traditional finance, like lend, borrow, and a whole lot more. However, DeFi's assets and protocols are independent of government policies. Bitcoin is programmed so as to have a fixed supply. Similarly, borrowing and lending markets aren't controlled by central banks setting interest rates. These rates are instead just set by demand for assets. What's more is that no middlemen means lower barriers to entry. Anyone with a digital wallet can participate in DeFi, and there are no lengthy bureaucratic processes for when, for example, taking out a loan. So how does DeFi compare to traditional finance? The main idea behind generating interest is the same. It's generated by borrowing and lending activities. However, there are a lot of other important differences. With DeFi, interest rates are set by the market, which will offer a higher return than traditional savings accounts. DeFi has low barriers to entry. Anyone with a wallet can participate, and it's easier to take out a loan so long as you have collateral. However, traditional finance offers more protections for customers. With blockchain, you are always in control of your funds, responsible for your actions, and bear all the risk yourself. The main example of DeFi I'd like to discuss today is savings accounts, or what we like to call earnings. They work similarly to traditional savings accounts. Borrowing and lending generates interest. However, central banks cannot force low rates. Interest rates are set purely by supply and demand. As a result, blockchain savings can offer impressive returns, sometimes up to 10% or even more. But what are you lending and who is borrowing when you use blockchain-based savings? Essentially, users are lending out their own crypto assets to traders or institutional who want to use them to take positions in the market. What should you know about DeFi loans? The most popular assets to borrow are stablecoins. These are pegged to national currencies like USDC, a regulated dollar stablecoin. These coins are lower volatility than assets like ETH and BTC, ETH being Ethereum and BTC being Bitcoin. Secondly, DeFi loans need to be over-collateralized. This protects lenders since positions are liquidated automatically if it seems a borrower cannot pay back. And then finally, and probably most importantly, is interest rates go up when more people borrow particular assets. If lots of people borrow USDC to purchase extra ETH, like in our example, then the APY or interest on USDC increases. Interest rates go up, allowing for higher yields than bank savings accounts. It's also important for customers to be aware of the risks of DeFi. So most EU bank accounts are insured up to 100,000 euros. This isn't available with current blockchain solutions. If you lose the keys to your blockchain account or an exploitation is found, then you could lose all access to your funds. There are also potential risks with the underlying assets. Stablecoins may lose their peg to national currencies for a number of reasons. The most popular stablecoins are all pegged to the dollar. This also means that users outside of the US face an exchange rate risk when purchasing these to lend out on the blockchain. Users can gain higher returns, but they need to be informed and responsible. The main problem with DeFi right now is not these risks, but it's actually that there are no user-friendly gateways to DeFi. This is the main problem blocking the growth of DeFi today. If a user wanted to earn 8% APY, which is interest, on a stablecoin, this is what they would currently have to do. First step, purchase USDC or ETH from Binance or a similar platform like an exchange. Then you would add MetaMask to your browser extension and create a wallet. You'd then send USDC and ETH from Binance to your MetaMask wallet. You would then connect your wallet and deposit USDC to Aave to start earning. Aave is a leading savings marketplace in DeFi. With each transaction, you're incurring a high cost in network fees because it's going over Ethereum. All of these current gateways are multi-platform with a poor technical UX. There's no simple instruction manual to figure it all out. So what needs to happen for everyone to access these high-yield opportunities? Well, people need access to simple tools, unlike the complex process I just showed you. So what will these easy, accessible tools look like? Well, firstly, the user experience has to be like a traditional savings account. You don't want to change user behavior. Users need to be able to deposit cash directly without purchasing crypto or stablecoins. We also need to reduce expensive blockchain fees or remove the need for blockchain knowledge entirely. And then finally, we need to mitigate risks further, like exchange rate risks for those who don't use dollars. Here's an example. So this is what Nash is building. In just a few taps, you can go from depositing cash to a high-yield crypto earnings account. This is the opposite of the complex, expensive, multi-platform process we showed you earlier. Our goal is to make DeFi simple, safe, and easily accessible for everyone. What's the outlook for the next few years? Well, at Nash, we believe that we'll see an increasing integration between traditional and decentralized finance as the traditional sector fights to remain competitive. The traditional financial industry is worth over 20 trillion. DeFi today is a relatively small industry worth 150 billion, but growing exponentially. We see DeFi replacing traditional finance. This will be good for everyone who is affected by low interest rates. People will have more choices available. DeFi will be the new, smart way to grow your wealth. Look at the huge jump from the internet, Web 1.0, to social networks, Web 2.0, a genuine revolution in both technology and society. DeFi represents Web 3.0 and is still just getting started. So there's definitely a lot to look forward to. If you'd like to learn more about Nash, please visit our website at nash.io or download the app. Thank you.